Now that we've talked a lot about the preludes to consolidating our tax returns, let's talk about the process. How do we actually do it? And will you need to know this for the exam? Well, it's a possible sim. You could have a sim on consolidating these tax returns, and that's possible. Is it the most likely? No, but it's definitely something that you should know how to do. Also, could you see multiple choice questions on this? For sure. So definitely something to keep in mind, and we're going to run through lots of examples with numbers and making sure that you understand the calculations. Now, first we've got the steps. In order to calculate consolidated taxable income, we need to follow a series of steps that involve calculating and adjusting the taxable income of each group member, as well as making various other adjustments. First off, we're going to have to calculate the standalone taxable income of each member of the group, which, okay, that's fair. Begin by calculating the taxable income for each member of the consolidated group as if they were filing separate tax returns. This involves determining each member's revenues, expenses, and deductions, as well as applying any applicable credits. Next up, we want to adjust each member's taxable income to remove the effects of transactions between members of the consolidated group. This is just eliminating any intercompany transactions, which again, this is something we for sure see on FAR, and just making that connection, because if you remember that from that exam, if you've taken it, then you can apply your knowledge here. After calculating the standalone taxable income for each member, adjustments must be made to account for transactions between group members, because these are not real transactions. If I make a sale to a 100% owned subsidiary, guess what? That's not a real sale, and as such, we shouldn't be taxed on it. The adjustments are going to include gains and losses deferred on intercompany sales. If a group member sells an asset to another group member, any gains or losses from the sale are deferred until the asset is sold to an outside group. That's definitely multiple choice questions you could see where we've got a question that has the parent selling to a subsidiary, the subsidiary sells to a third party, and if there's a gain or loss on the sale between the parent and subsidiary, that gain or loss is deferred until the sale reaches its way to an outside party. When this occurs, a subsequent adjustment must be made to recognize the deferred gain or loss. Any inventory adjustments, if there are intercompany sales involving inventory, adjustments may be required to properly account for the cost of goods sold and our ending inventory values. Now, lastly here, any dividend exclusion, dividends received by one member from another member are excluded because it's basically as if we're just transferring profits between companies, and that's really, there's nothing crazy about that, right? Next up, we want to remove items that must be determined at the consolidated level. So certain gains, losses, and deductions must be determined at the consolidated group level rather than at the individual member level. These items must be removed from each member's taxable income, and these are the items here. We've got capital gains and losses, 1231 gains and losses, net operating losses, charitable contribution deduction, and our dividend received deduction. So as a reminder, we got two more steps, and then we will be seeing numerical examples with this. So we will be able to visualize what's going on and get some practice with it. Next up, we want to combine each member's adjusted taxable income. After making the necessary adjustments to each member's taxable income, we want to combine the resulting figures to create the group's combined taxable income. And lastly, we want to adjust the group's combined taxable income for the items required to be determined at the consolidated level. So finally here, we want to adjust the group's combined taxable income for the items mentioned in step 3. This involves calculating the consolidated amounts for capital gains and losses, 1231 gains and losses, NOLs, charitable contribution deductions, and our dividends received deduction. So you can make a flashcard of these. I mean, we've got resources on how to memorize these steps. I think for our purposes, the best way to do it is practice and going through what we're about to see. As promised, here we go. What we see on the left side of the screen, this is going to maintain the same throughout all the steps. We're going to see the same information for each of the slides on this example. We're going to go step by step. First off, we're considering a consolidated group consisting of 3 corporations. We've got X, Y, and Z. Corporation Y and Z are wholly owned subsidiaries of Corporation X. Financial data for each corporation is as follows, and we've got this here. I'm not going to read it through. We'll just reference it as we need it. Now, first off, we want to calculate the standalone taxable income for each corporation. We see that Corporation X has gross revenue of $1 million, cost of goods sold of $400,000, and we've got $200,000 of operating expenses. Now, this is the taxable income without taking into account all these fancy items such as intercompany transactions, charitable, dividends received, or anything like that. So just keep in mind, again, these are the simple and normal transactions, really just dealing mainly with gross profit, but then also getting into operational expenses as well. We see here taxable income before adjustments, $400,000. Then we get over to our Corporation Y, do the same thing, and same thing for Corporation Z, just gross revenue minus any expenses, just normal expenses, before dealing with intercompany, because we see intercompany, paid to Corporation X, paid to Corporation X, So, and charitable contributions, these are all items that we take into account in our latter steps. Next up, we've got step 2. And step 2 is where we're going to adjust each member's taxable income to remove the effects of transactions between members of the consolidated group. So we carry forward our taxable income before adjustments from our step 1. We see them here. And what is happening? Well, we're removing all of these items that are intercompany because presumably these are included already so interest income received, that's probably going to be included in our gross revenue, but it's not real revenue because it's just transfers between our related parties. So we were removing $10,000 because, again, I'll say it one more time, is that presumably that $10,000 was accounted for in our revenue or just in our income. So we want to remove that. And again, we want to eliminate all these dividends because, again, it's likely that these were included somewhere here. Now, I know gross revenue, you might think, oh, well, that probably has more to do with sort of business transactions, sales, and that might not include income from interest and dividends. And to which I'd say, yeah, you're likely right, but there's only so many lines of items that we were going to include here. I mean, where would these realistically be? We could see gross revenue from sales, and then we'd see other income items, other revenue. Now, yeah, like that's the case. And if that's not something you considered, no worries. But yeah, it's presumed that any items below any intercompany are included in these items, and that's why we are subtracting them out. Not even subtracting them out. We'll see that we're adding things back. We're adding interest expense for this. We just want to counteract the effects of what we're seeing. So here for Corporation X, we've got our original taxable income before the adjustments of $400. We're removing the interest income because that's an intercompany transaction, removing dividends from the other two entities. For Corporation Y, we have our taxable income before adjustments. And the only item here that we're dealing with so far is that we have interest expense paid to Corporation X. Now, why are we not taking into account this $50,000 of dividends paid to Corporation X? Well, because we accounted for it here. And if we account for it twice, then that would be essentially double counting the effect of removing this. Lastly, we want to deal with Corporation Z, and Corporation Z has $200,000. Now, we already took into account the dividends paid to Corporation X over here, and we see in practice, which just making a pause here, it's great that we're seeing real life examples and how this all works because now you see that we're only using these items once. So because we use the 50 here, we're not using the 50 here. Because we use the 25 here, we're not using the 25 here. And we're just not at the charitable contribution step yet, so we're still ignoring those, but we will deal with them. Moving on to step 3, we see that we have our adjusted taxable income accounting for all of these intercompany transactions. And now we're simply just removing the charitable contributions, getting our new taxable income before consolidation. A nice step-by-step process, not too much to consider in any individual step, but this will take practice for sure, but you can do it. And now we've got step 4 and step 5 all together. We want to combine all the taxable incomes from the 3 entities, and that's a pretty simple step. We're just adding all the taxable incomes from our prior step. There we go. We have a total of $845. Lastly, for step 5, we want to adjust the group's combined taxable income for items required to be determined at the consolidated level. Now, what are items to be determined at the consolidated level? We're going to deal here with mainly our charitable contributions deduction, and we see that that is going to be $30,000, and we derive that from the $15,000 charitable contributions, $10,000 here, and $5,000 here. At the consolidated level, the group's taxable income before taking into account charitable contributions is $845. Now, assuming this 10% limit on charitable contributions, this is important because this just, as so many other lessons do, takes into account points from other lessons. We need to remember that there is a 10% limit on charitable contributions before considering them, we need to back it out of the income and consider that. So we are going to need to adjust the allowable charitable contributions because individually, all of these organizations, all of these corporations, they had what they knew they could deduct for charitable contributions, but now we need to redo this 10%. Since the group's total charitable contributions are $30,000, the full amount can be deducted because 10% of this newly calculated taxable income is $845. 10% of that is $84,500. So we can deduct the full $30,000. Now, in this case, we can, but maybe in other circumstances, we may not be able to deduct the full amount. If the full amount of charitable contributions was greater than $84,000, we would not be able to take that. We would be capped at $84,500. As such, what's our final consolidated taxable income? We're taking our $845 and we're subtracting out our charitable contributions deduction, leaving us with $815 as our final answer. Wrapping it up in summary, the consolidated taxable income for the group of corporations for all 3 is $815,000. And how are we going to determine if this is a good idea or not? Well, we would just look at what is the individual taxable income for each of these, and then what's the taxable income at the end of the day for all three together. And well, if the total taxable income for one is greater than the other option, we know we want to go with the lesser amount. The process involved calculating each corporation's standalone taxable income, making adjustments for intercompany transactions, removing items that must be determined at the consolidated level, combining the adjusted taxable incomes, and finally making adjustments for items determined at the consolidated level. Wow, that was actually not too bad, I don't think. I mean, it was a good amount of slides, a good amount of material, but I don't think it was the worst thing. Hopefully, you didn't think so either. Let's do a few more slides and call it a day. We've got another example here. Thankfully, this one's just going to be one slide. We're not going to deal with one after another. So Fruitco Inc. files a consolidated federal income tax return with its 100% owned domestic subsidiaries. In year 2, members of the consolidated group reported net book income or loss as follows. We've got these items, and Fruitco reported $150,000. Berry was $60,000, and Citrus looks like they had a pretty bad year. They reported a loss of $120,000. Now, Berry paid $60,000 in dividends to Fruitco in year 2. The dividends are included in Fruitco's net income reported above. Based on the information here, what is the group's consolidated taxable income for year 2? Again, this is a much more simplified, watered-down version of what we saw. And is that a good thing, bad thing? It's just a factor. We're going to have possible questions that are incredibly difficult, some that are more simple, and just at the end of the day, the more you see, the better off you will be prepared for the exam. So we're going to calculate the group's consolidated taxable income. We got to eliminate these intercompany dividends paid by Berry, since these dividends are included in net income but should not be counted. And this, another sort of concept you could tie this into is book to tax. When it go book to tax income and book to tax allowable deductions, there are some items that should not be included at all, right? Permanent differences. Kind of think of it like that, if that helps. Just a lot of things I'm comparing it to, making comparisons, and allowing you to understand the differences and similarities between lessons and rationales that the IRS puts upon different topics. So Fruitco is going to just adjust their income by reducing it by 60, leaving it at 90, because we don't want to get taxed on these dividends, because these dividends are just a transfer of wealth between consolidated, fully owned subsidiaries. We got $90,000 for Fruitco, no change to Berry, no change to Citrus. Like I said, this is much more simple than the example we had prior. Now we can finally calculate the group's consolidated income, which is going to be $90,000 for Fruitco, which is really the only one that changed. $60,000 for Berry minus $120 for Citrus, leaving us with $30,000. Now you see the $60,000. It's just a coincidence. I mean, in reality, not a coincidence. It makes sense that Berry might also always distribute all of their income to Fruitco as dividends, but that doesn't have to be the case. Just pointing that out. If Berry had $75,000 of income, maybe they would distribute $75,000, or maybe they would just still do 60. It depends. There's no rule here saying it has to be fully distributed, but just pointing out that's what we could be looking at, so you can consider that and maybe not get tripped up by it on another type of question. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.